Good morning and welcome to Market Monday for August 18th, 2025. Remember this? Ah yes, that unforgettable nostalgic thrill of connecting to the digital frontier. And last week AOL announced that they're going to be discontinuing their dial-up internet service after more than 30 years of operation. As we bid farewell to the early days of the internet, it does reinforce a topic that we discuss from time to time, which is essentially faith in the future. When AOL first began its service in 1991, no one could have fathomed what it would turn into 30 years later. The entire new industries that were created, trillions of value, the way of life as we know it. We don't pretend to know all the ways that the major innovations of today, like AI and blockchain technology, will shape our lives, or what industries, companies, or services will be created. But one thing's for sure, we continue to have faith in the future. Something else that we got last week was the 16th new all-time high in the S&P 500 stock market. Looking at the past 50 years, we see this theme of bunching. No new all-time highs for a number of years, followed by many new all-time high year after year. This is a feature of the stock market, just its nature. And while there are plenty of years with single-digit all-time highs, often marking the end of the bull market, 2000, 2007, 2022, more often than not, there are dozens of new all-time highs in any given year. Again, a feature of the stock market that generally rises over time. With 4 months left this year, we wouldn't be surprised to see this number tick up. One reason? Earnings. Here, we're looking at this year's earnings growth. Here's next year's expected earnings. And this over here is the 2-year combined figure. And even though the line may be sloping down a bit here or there, earnings are still growing. You see zero way down here? So look what we're seeing next year. 10, 12, 14% earnings growth. And we're gonna need it. See right here? This light blue is the contribution of earnings to the growth in the stock market. Less than half. The rest is coming from what we call margin or valuation expansion. The stock market becoming more expensive or investors paying more for the earnings that we just showed. This is at a time when the S&P 500 stock market certainly isn't cheap. By one metric, price to sales, it's the most expensive that it's ever been, but that hasn't derailed companies from buying back their own stock. Here are the buybacks every year for the past 12 years. Here's COVID down here. Here's last year. And would you believe it? Here's this year on pace for the most buybacks in history. That's also a major force in supporting stock prices. And lastly, here's the federal budget deficit for each July going back 15 years. That's the federal government spending $291 billion more than it received in just the month of July alone. For context, tariff revenues seem to be hovering around $25 billion per month, and they're included in that $291 billion deficit. This brings the deficit to $1.63 trillion so far this fiscal year, which runs from October through September. We're still paying over $1.1 trillion of annual interest. So despite an expensive stock market, we believe these three factors could help support stock prices for the remainder of the year. But remember this, Warren Buffett's cash pile, a record cash pile, $350 billion exactly, that's the highest it's ever been. Had you used this to time the stock market and predict a sell-off, you also wouldn't have been participating in those 16 new all-time highs in the stock market. And while we're at it, today we'll leave you with this.
5 years ago, right here in these chairs on Fox Business, you called it rat poison, but that was when it was about $150. Today it's $9,000. It had hit $19,000.
So it's more expensive rat poison.
Well, Harvard and Brown University endowments just bought $140 million worth of rat poison. Have a great week.